let's talk about what cost segregation is. It's a little bit different than what CPAs typically do. CPA will take the value of a building divided by its economic life, and that's your depreciation amount. Now, there are two really different types of buildings. You've got your typical commercial building, which is like, a retail space, office space, hotels. Airbnbs, believe it or not, are commercial buildings, and we'll talk about that a little bit too. And so that's a 39-year asset, right? Residential buildings, whether it's a single family house rental or multifamily apartments, those are 27.5-year asset. So there's a difference there, the two building types. Now, what cost segregation does, it says, you know what, those assets don't belong just in one bucket. So we're going to break up into different buckets. So this can be the building structure, is going to be then that 39 or 27.5-year bucket. But then you've got things like tangible personal property, QIP, or what used to be called leasehold improvement, and then land improvements, things outside the building, are in the 15-year category. So once you do that, that means you can take that depreciation and record it sooner, and that's called accelerated depreciation, which is just to differentiate it from straight line. We talked about everything going in one bucket. When you break it down into its component pieces like this is called accelerated. And one common misconception is that people think, if I'm accelerating my depreciation, I won't have anything in the later years. That's not correct. The building structure components will not be accelerated. It's just the things kind of inside and outside the building. Okay. So let's talk about what some of these things are in these different buckets. Of course, if you got the structure, that's your structural steel, walls, doors, plumbing, electrical, all the basic building systems. Tangible personal property is some of the more, let's say, the interior things like decorative molding, carpets, flooring, specialty plumbing. What I mean by that, it's like in a dentist's office, you got way more sinks and plumbing than a typical building would require. Specialty electrical, if you've got dedicated circuits for special equipment like MRI machines or things that need their own circuit, that's going to be over and above what a typical building would have. And so that's in that tangible personal property category. Then leasehold improvements, or QIP now, and the QIP stands for qualified improvement property. That's your interior renovations, your sheetrock, your non-load-bearing walls, flooring, lighting, interior plumbing, electrical, even interior paint is included in that. Land improvements is your parking lot, the striping, the concrete, the asphalt, signs, flagpoles, security systems, everything outside the building, okay? And unless you've actually put in a parking lot, you wouldn't believe how much parking lots cost. And so having that in the 15-year category is very nice because you can depreciate that faster. So let's take a look at what happens when we actually break up a depreciation and apply cost segregation to a building. These are all buildings that I've been personally involved in. So just to let you know that. So this was one of my first studies that I've worked on. It was a 2-story building down in the Sugar Land area, 20,000 square feet. Building cost $5.1 million. And the person had owned it from June 2018 until the year end 2020 when I got involved. They were going to be recording $338,000 in depreciation over that time period. We did a study and broke it up into these categories. You can see there's still quite a bit there for building, but all these other categories had a lot of money associated with it. So that's all things that are going to be accelerated, right? They can be written off sooner. Now, once we have that all broken down, there's some other tax laws that come into effect. You may have heard of bonus depreciation. All these things in this green box are less than the 20-year asset life, which means they're eligible for bonus depreciation. You add all these things up in the green box, you now have a little over $2 million in depreciation that they can record in the current tax year, as soon as we did the study. So that's quite a difference from $338,000 in accumulated depreciation to over $2 million in 1 year. That's a massive cash flow increase, right? Let's look at some other things, but before we do that, bonus depreciation, there's a lot of misconception on it. And the bonus depreciation, the year that you take that really applies to when you bought or built a property, not when you study it. So for instance, the 100% bonus depreciation applied for any building that was placed in service after September 27, 2017 through the end of 22. The language you see here, it's language from the legislature, so I don't know why they just can't say January 1 to December 31st. As you see the next one, what we're into right now is the 80% bonus, right? So it's after the end of 22 and before the beginning of 24. In 24, it drops to 60%, and then 40%, and then 20%. This is the way the law is written right now. And this came from the Tax Cut and Jobs Act of 2017. I would be willing to bet money that if we elect a Republican president, this will be extended. This is a great deal. And a lot of people in Congress actually own commercial property, believe it or not. And so they're all for this, even though they may not say as much in public. This is what they want to do. And that's the way the law got written, because everybody approved it. Just remember that. So let's look at another one. This is a car wash. And this was a massive facility. This is $7.4 million, not including land. This is just the facility. 34 vacuum stations, 200-foot car wash. And they completed it in December of 21. So 1 month's worth of depreciation they were going to write off in 21 was $8,000. Once we broke it down into different components and then applied bonus depreciation, they now had a write-off in December in the year 2021 of $5.2 million. That's a depreciation deduction. Think about that for a second. $7.4 million, and they wrote off 5.2 in the first year. I don't know how many years of income taxes they didn't have to pay, but this is what that does. If you have that big a deduction, and this one thing to understand, cost segregation can increase or create a net operating loss, because it's usually that big of a deduction that it could wipe out all of your income and you don't owe any income taxes. So just think about that. So here's some things that are probably more in line with what you guys are involved in. This is an Airbnb, and this is actually in Nashville. Almost 4,000 square feet, $1.3 million. This is a very massive building. It doesn't really look like that. 18-inch stone walls on the first floor. And it actually has a basement that has 2 recording studios. That's why it costs a little bit more than your typical Airbnb. So again, straight line depreciation, they were considering about $98,000 for the year 2020. We did the study, applied bonus depreciation, and now they had a $239,000 deduction. So you can see it doesn't take a huge building to get a really nice return on a study. Now here's one's a little bit more in line with some of the Airbnbs that you may think of. This is actually one kind of in the Conroe Woodlands area in Texas, 1,700 square feet, very kind of standard house, $325,000. Again, this is just the building value, not the land value, just building. $325,000 they were looking at in that year, only writing off about $2,400 in depreciation. When we did the study and applied bonus, guess what? $103,000 in the first year that they turned this house into an Airbnb. That's about a third of his investment. Not too shabby. Here's a really interesting one. This is up in, I think this is in Rhode Island. Check that year built, 1745 is when this building was originally built. However, the owner that I've worked with just bought it in August of 2022, $838,000. We did the study, applied bonus. He got a write-off of like $215,000. So that's one of those things you can see. This is a really beneficial process and a beneficial method to use. Now, some of you may know a little bit about cost segregation. I've got some true or false questions out here. So it's a pop quiz. I'm going to say whoever wants to shout out their answer, please feel free to do so, and we'll kind of discuss them as we go. So the first one, cost segregation can only be done on newly constructed or newly purchased commercial buildings. True or false?
False.
That is false. That's a big misconception that some people have, even some CPAs have. They think it's no longer new, you can't do that. Absolutely not. The only requirement, or the only, I would guess, caveat to that is if you've owned the building like for 20 years or more, there may not be anything else that we can accelerate because it's already been depreciated. But for anything, especially up to 10 years of ownership, let's definitely take a look. It doesn't hurt to take a look at it. So second one, cost segregation study is only cost effective on multi-million-dollar facilities.
No. False.
False.
False. Very good. Very good. You're catching on here. How about this? A cost segregation study is an audit trigger for the IRS.
No.
False.
False. Yeah. Cost segregation is in the IRS code, so that shouldn't be a trigger. They just want to make sure that you're using a third party to do your study. They don't want your CPA conducting the study or you conducting the study or doing some kind of software-based cost segregation. That's when they look at it and they may say, let's take a look at this because this number doesn't look right. If you're using a third party, like Cost Segregation Services, the company I work with, which is the largest one in the nation, by the way, they understand how that we know what they're looking for. So they're not going to question that typically. There's another one. For commercial buildings owned more than 1 year, you have to file an amended tax return to receive the maximum tax savings. People are thinking, huh?
True.
True.
That is false. All you're going to do, you can own it for 5 years, and then what you need to do is file a change of accounting form, and that's what we can help provide. That change of accounting form just says, you know, I was doing straight line before, but this year I'm going to change to accelerated, and the IRS will let you go back and grab the depreciation you should have taken in those previous years, record it in the current year, so it makes you whole going forward. That does not require an amended tax return. That is one of the biggest misconceptions about cost seg that's out there. And we all just proved that because there was a real delay before anybody answered the question. Okay, here's another one. Once a commercial building has been entered on a depreciation schedule, there is no further opportunity to uncover depreciation savings.
False.
False.
That is false. And we find usually 30 to 50% more depreciation than what somebody might have entered, because a lot of times CPAs will inadvertently put everything under one lump sum building number and put in at 39, and then we can go in and drill down and break that out and help them depreciate it accordingly. And the last one, you must wait until the construction on the commercial building is completed before you can estimate the tax savings.
True.
False.
That's kind of a trick question. We can't do the study, the full study, until the building's finished, but we can always do a preliminary estimate based on some things, just some like 4 pieces of information I need to actually run an estimate. And I'll show you what those are at the end, toward the end of the presentation. But we can do an estimate at any time, even before construction is started. We can, you know, based on your budget and based on looking at some of the artist renderings or drawings that you're planning to build, we can get a pretty good estimate of what we can save you and what our fee would be at that point. We've done this for over 40,000 buildings across the US, so we kind of know what we're talking about. Okay, now Joseph has talked about the real estate professional designation, so I want to talk about this. Now keep in mind, even if you're a realtor, if you're a licensed realtor, that does not make you a real estate professional as far as the tax designation goes. So let's talk about what a real estate professional is. So let's say you have, this is without the real estate professional designation. Let's say you have several commercial buildings and that rental income is coming to you as passive income, right? Now, the great thing about cost seg, even if you're not a real estate professional, you can do a cost seg study on one building, and that savings will offset all of your rental income from all of your buildings, not just the one you studied, right? So that's very helpful. If you had multiple buildings, you could plan to do one study on one building a year, and that's going to help you tamp down your rental income, which means you're going to be paying less income taxes on that income, which is a good thing. Now, for a real estate professional, if you have the real estate professional tax designation, you're going to have some commercial buildings, but then you've got some other businesses that's real estate related, right? You may have some property management business, a real estate development business, and other real estate things where you've got all of this income coming in. So that becomes active income for you. So in this case, when you do a cost seg on one of your buildings, since you're a real estate professional and all that income is active, that cost seg is going to offset your total income, not just the passive income. Okay. So let's talk about what a real estate professional designation means. And I'm going to use a lot of words because I want to be absolutely clear. The taxpayer, in order to get the real estate professional, must provide more than 1/2 of the total personal services in the real property trades or businesses in which the taxpayer materially participates. That's key. That material participation is very important. And must perform more than 750 hours of services during the tax year in the real property trades or business. Now, understand there's only about a little over 2,000 work hours in a year, right? So 750 hours is a lot. And so what that means is if you have a W-2 job of any type, you're probably not a real estate professional because you don't have enough hours left to be able to work 750 hours. And oh, by the way, the IRS wants a lot of documentation. They want to see logs, all of that information on just documenting the hours that you spend. And we've heard all kinds of horror stories about people getting called in before the IRS and having to produce these logs. And then they say, okay, well, I'll come back tomorrow and I'll produce my logs. And we've heard stories of people being called out because the ink that they used to write their logs was the same ink. And the real estate auditor said, no, you just made all this stuff up last night. So they disallowed it. So you've got to have some pretty definitive logs, something that didn't look like you just put it together overnight. Okay. A little bit more information on the real estate professional. Just because you go ahead.
Sorry, real quick, Tom.
Yeah.
Can you provide everyone some examples of ways to log, log their time as a real estate professional, if it's ever.
Absolutely. So if you've got, the big thing is kind of mileage logs, right? Yeah. Showing that you drove from point A to point B and how many miles that is. Also logging all your activities. So if you had to go do an inspection of a property and you were there for an hour and a half doing that inspection, you have to log all of your activity. I mean, the IRS doesn't give you an example of what to do, right, but they know what's believable when they see it. So that's the one thing you want to be very meticulous in your log entries. I know there's a lot of apps out there that can help you, number one, like log your mileage. And those are pretty beneficial. Once you get in the car, it's on your phone. And once you start driving, it'll record how long you were in there, how many miles you recorded. And at the end, it will say, was this a business trip or not? So that way it'll help you identify all of your driving, but they also want to see how much time you spent and what you did on the property. So it's a pretty strict documentation requirement that you have to have. So this is not something you want to undergo lightly. You want to think about it and make sure you're going to meet all the requirements. Yeah. So like I said, qualifying as a real estate professional really doesn't automatically make all your taxpayers' rental income non-passive. Only those rental activities in which you materially participated are non-passive. So that's one thing to remember. Okay. So we talked about how we get an estimate, and to get really a cost segregation estimate, it's easy. It's very easy. And CSSI provides a no cost, no obligation estimate. And I mentioned having the 4 pieces of information. And here are these 4 pieces. The purchase or construction price of the building. This number, the price here, is going to exclude land. So, because you can't depreciate land. But if you don't know the land value, that would be something you say, I'm not sure what the land value, and we can come up with an estimate for that, and we would run that by you and say, is this something you think is reasonable? Because we have to get to just the building only price. After that, we need the month and year it was placed in service for your use, not when it was originally built, when you bought it. Okay, month and year. Then any renovations you've done after you purchased it. For, let's say, an office building, this would include the tenant improvement allowance. If you paid for any of those, I mean, that's a big feature that a lot of landlords are doing now to attract tenants, that they'll help either contribute towards the build out or actually pay for the build out completely. If you're paying for the build out completely, that's something you could run through a cost seg. So it makes sense that you might want to do that. And then the last thing is really just an address and a brief description of the building, like 123 Main Street. And it's a 10,000 square foot office building with 2 floors, just kind of some general information. Based on that, those 4 things, we can usually turn an estimate around in 2 business days. There's a lot of real estate listings for properties that once they're listed, they're out there forever. So I can find a property that maybe you bought 5 years ago. That real estate listing is probably still on Redfin or one of the other real estate listings where it can give me the square footage and everything else, plus some property tax information as far as the land values, at least how they assessed it. So there's information I can get from public sources. These 4 things sometimes I can't get from public sources, so that's why I'm really asking for that. But really, cost segregation especially when we offer a no cost, no obligation estimate, it's not going to cost you anything but the time to give me these 4 pieces of information. And then we'll come back and show you what we can save you and then what the cost is going to be. And that way it's something you can make a decision on. So this is a very easy thing. Interesting to note that short-term rentals and more of the long-term residential rentals this past year made up 17% of our business. And so it was a huge increase for us, and CSSI had to go out and actually hire additional staff because we just had so much of that activity kind of in the space that you guys play in. So it's one of those things where if you're not doing cost segregation now, you should, because you're leaving money on the table that you don't need to be paying to the government. So I know that was a lot to throw at you. I'm going to kind of stop there. This is my contact information. So if you want to take note of that, and I'll just open it up for questions.